So, today we're digging into the Middleby Corporation, a real giant in the food equipment world. Chances are you've eaten food cooked on their gear without even knowing it. But, for investors, despite all that success, the company has become this really complex puzzle, one that management is now trying to solve for everyone.
And that brings us to the big question, the one we're going to explore today. Is this massive company actually worth more if it's broken up than it is altogether? It's a huge question, and one that pretty much everyone, from management to the market, is trying to answer right now. First off, let's just get a sense of the scale here. Middleby isn't just some company. It's practically a global empire with more than 120 different brands under its belt. We're talking about everything from those high-end Viking ranges you see in dream kitchens to the massive industrial ovens that bake the bread for your sandwiches.
But that incredible scale? It's created a classic Wall Street headache, the conglomerate discount. The idea is pretty simple, actually. When you lump a bunch of different businesses under one roof, the market kind of gets confused. It has a hard time figuring out what the whole thing is worth, and often it just slaps a lower price tag on it than if you valued each piece separately.
So here's our game plan. We'll start with the puzzle itself, then break down the three very different businesses that are causing it. After that, we'll look at the dramatic solution, the big split, and meet the two new companies that will come out of it. We'll weigh the risks and the strengths, and then, at the end, we'll tie it all together into what we're calling the value unlock thesis.
All right, let's start by trying to unpack this puzzle. How did a company this successful end up with a valuation problem in the first place?
Well, the heart of the issue is this. Under that one Middleby name, you've got three really successful but totally different operations. They sell to different customers, they have different sales cycles, they even react to the economy in different ways. For an investor trying to analyze all that at once, it just creates a lot of noise.
So, let's get to know the three main players in this puzzle. It's really important to see just how separate they are.
If you look at where the money comes from, commercial food service is clearly the heavyweight champ, making up over 62% of the revenue. That's all the equipment in restaurants around the world. But you can't just ignore the other two. Food processing and residential kitchen are huge businesses on their own, each pulling in over $700 million a year.
And this slide just nails the disconnect. Just imagine being a salesperson there. One day, you're pitching a global fast food chain on how efficient your new fryers are. The next day, you're talking aesthetics and design with a luxury home builder. Then the day after that, you're in a factory helping a huge meat processor get more out of their production line. Come on, those are three completely different worlds. So this brings us to a major turning point. Faced with this nagging conglomerate discount, Middleby's management decided, you know what? We're done trying to explain this puzzle. It's time to solve it.
And they moved fast. Really fast. February, they announced the spinoff. By May, they're already beefing up their share buyback plan. And by August, they're buying new companies for the very segment they're about to spin off. This wasn't a slow pivot, folks. This was a rapid, all-out strategic assault.
A huge piece of this was the arrival of an activist investor, putting Ed Garden from Trian Fund Management on the board. On the very same day they announced the spinoff, sent a massive signal to the market. This wasn't just some internal idea. This was a direct response to shareholder pressure to unlock value and to do it now.
And you don't have to take my word for it. Here it is, straight from the CEO. This quote basically confirms the whole problem. Management looked at their stock price, and they agreed with the activists and with the market. They said, yeah, you're right. The true value of our company is not being recognized.
So, what does the future look like after all this? Let's meet the two companies that are going to emerge from this big strategic split.
The answer is to create two pure-play companies. RemainCo is going to focus on the commercial and residential kitchen stuff, while SpinCo will be a dedicated leader in food processing equipment. The whole theory is that these simpler, more focused businesses are way easier for investors to understand. And when that happens, the market often rewards them with a higher valuation. So if we break down the new structure, RemainCo is the bigger entity at about $3.1 billion in revenue. But SpinCo is no slouch either. It's a $700 million business with a really attractive 26% adjusted EBITDA margin. What you end up with are two very distinct, highly profitable businesses that investors can finally look at and value on their own terms.
Of course, no big change like this happens without challenges. To get the full picture, we have to look at both the risks the company is facing right now and the fundamental strengths it's got going for it.
Okay, in the short term, there's some real headwinds. New tariffs could add about $150 million in costs per year.
Some of the big fast food chains are being a little tight with their spending, and yeah, like any industrial company, they're sensitive to what the economy and interest rates are doing.
But balancing all those risks is a really powerful competitive moat. You've got over 120 strong brands, a global service network that is almost impossible for a competitor to copy, and they're a leader in new technology. And maybe most important of all, they're riding a massive long-term trend, the need for automation. With the labor costs going up, restaurants and factories need machines to be more efficient, and that creates this steady long-term demand for what Middleby sells.
So, how does this all come together? What's the final investment thesis? Let's connect the dots and see how all these moves could potentially create a lot of value for shareholders. $448.9 million. That's how much of its own stock Middleby bought back in just the first 7 months of 2025. When a management team spends that kind of cash on its own shares, it's screaming confidence. They're basically telling the market, we think our stock is cheap right now.
And to put that buyback into perspective, that move erased 5.7% of the company's total shares from the market in just 6 months. That is an incredibly aggressive pace. It means they're using almost all of their extra cash, not just to run the business, but to actively boost the value of every single share that's left.
So here's the key takeaway. This isn't just one single action. It's a three-pronged strategy. First, you've got the strategic spin-off to make the story simpler. Second, you have the activist on the board, keeping everyone focused on shareholder value. And third, you have those aggressive share buybacks directly supporting the stock price. It's a full court press.
Which really just leaves us with one final question. Middleby has identified its problem, this conglomerate discount. They've laid out a very clear, very aggressive plan to solve it. So now, with a whole new structure and a brand new strategy, the only question left is, will the market finally see the value that management is working so hard to unlock?